So, hey everyone, it's me, your Manu Isu, and welcome to my channel Manu Isu ACCA classes. And I'm back with a new video for the F7 Kaplan kit. So, question number is for 14. What is the requirement? We will look first. Okay, so requirement is to prepare the consolidated statement of financial position for Premier as at 30 September 20x0. Okay, so we will do working here. First, we will note down additional information here, and down below we will do pi walking. Okay, and we will write down a small note that all figures are calculated in dollar common 1 2 3. Okay, okay, so just a wait. Okay, okay, so here we will do walking. Okay, so first we will make a we will do a working one. It is for the group structure. Okay, here first then we will read a question. On 1st June 20x0, Premier acquired 80% of equity share capital of Sanford. Okay, it means Premier is a parent company and Sanford is a subsidiary company. Okay, we will write here Premier equal to parent company and Sanford equal to subsidiary company, and percentage acquired by parent equal to parent percentage 80%. Then NCI percentage equal to 20%. Okay, and we will write a date of acquisition. Date of acquisition is 1 June 20x0, and our year end is 30 September 20x0. So time of acquisition equal to June, July, August, September. It means 4 months. Okay, okay. Then we will read a question again. TPC. So 1 June 20x0, Premier acquired 80% of equity share capital of Sanford. The consideration consists of two elements: a share exchange of 3 shares in Premier for every 5 acquired shares in Sanford. Okay, the first is share consideration. Okay, so share consideration, we will take first number of share acquired by parent. So 80% of total number of shares in subsidiary, and we will get this figure from the balance sheet, that is the financial position of Sanford. Here you can have a look on it. The equity liabilities of Sanford, in the equity and liability portion of the Sanford, there is equity share of nominal value 1 each, that is the 5,000. Okay, so here the total number of share is 5,000, because nominal value is 1, so number of share will be same 5,000. Okay, then we will a parent have given his 3 shares and taken the 5 share of subsidiary. So we will divide, sorry, we will multiply in the ratio 3:5. Yes. Then we will multiply it by the market value of parent company, which is given in the question, that is the 5. Okay, so this one is share consideration, and the share and 800 cash. So cash consideration equal to 800. So total is plus this. So share issue has not yet been recorded by Premier. Okay, it means share consideration journal entry. Okay, so first we will debit investment. Okay, and then credit share capital. I will write in the shortcut. Then credit share premium. Okay, so investment is, we have already calculated, that is 12,000. Okay, and in case of share capital, we will copy this same, but only the difference will be okay. So here, just have a look on the formula bar. I am making some changes. Here we have taken the market price. We will eliminate this. Instead of that, we will keep the nominal value which is given in the question, that is 1. Okay, and share premium is difference of these two, that is 9600. Okay, so then after, we will read a additional information given below and note down one by one. Okay, so here additional information number 1. At the date of acquisition, the fair value of Sanford assets were equal to their carrying amount with the exception of its property. This had a fair value of 1.2 million below its carrying amount and had a remaining useful life of 8 years at the date of acquisition. Sanford has not incorporated this in its financial statement. Okay, so this is a question. This additional information is same as we have done in the previous video questions. So only the difference is that in previous video questions, I mean in the question which we have done in the previous video, there is the excess amount of the fair value above its. I'm sorry, the fair value is excess of its carrying amount. Here the fair value is below its carrying amount. Okay, so we have to do fair value adjustment, that is the 1200. So we have in previous one cases we have added just the fair value in the PPE, but here we won't add because it is below its carrying amount. So we will deduct this amount, and then we will journal entry would be journal entry. So credit PPE by 1200 and debit net assets list, both at acquisition as well as at reporting date. So 1200. Now we will calculate post acquisition depreciation. Okay, so depreciation, the question have, I mean additional information have given us the remaining life as well. So we will just divide it by 8, and the time of acquisition is 4 months, so we will multiply it by 4 by 12. So post acquisition depreciation is 50. So this will be added both in the net asset calculation of subsidiary as well as while in consolidated financial positions also. So post acquisition depreciation and journal entry of the same will be debit PPE and credit net asset at reporting date. ठीक है? Okay, so we will read out the second additional information. Premier had a 2 million at a cost to Premier of inventory that has been supplied in the post-acquisition period by Sanford as of 30 September 2080. Sanford made a markup on cost of 25% on these sales. Okay, it means Sanford, who is subsidiary, have sold to parent, that is the Premier. Okay, and unsold goods in inventory or unsold inventory equal to 2000. We have taken the 30 in common, and then markup is 25%. So markup is basically charged on the cost, but here selling price is given and markup is given. It means if selling price is given and markup percentage have been given, then selling price would be 125%. Okay, so we will calculate POP. So POP, we will simply multiply, no, we will multiply 2000 into, so we need to find a margin which is 25%, and selling prices I told right now, if market and selling price is given, your selling price will be 125%. So we will divide it by 125%, we will get POP as a 400. So next information in additional point is, okay, so 3 number, Premium had a trade payable balance owing to Sanford of 350,000 as of 30 September 20x0. This did not agree with corresponding receivable in Sanford books due to 130,000 payment made to Sanford, which Sanford has not yet recorded. Okay, so here the Premier had a trade payable balance which to be payable to Sanford. Okay, so this is the intra company sales transaction, so we need to cancel it out. So first we will debit payables. The amount is 350, we have taken 30 as a common. Then we will credit. Okay, actually the Premier had made a payment to Sanford of amount 130, but Sanford had not recorded this amount. It means the cash we will debit cash in transit. So I will write it in shortcut CIT, which means cash in transit. The amount is 130, and we will credit receivable to cancel it out. So amount will be total of these two. Okay, so next point is the Premier's investment include investment in the shares which has a date which at the date of acquisition were classified as a fair value through other comprehensive income. The investment have increased by value of 300,000 during the year. The other equity reserves relate to this investment and is based on their value as at 30 September 2009. Okay, there were no acquisition or disposal of any of these investment during the year ended 30 September 20x0. Okay, so basically the investment value have been increased by 300,000 during the years, which we will need to record this amount while preparing the statement of financial positions in the equity section. Okay, so we will write down here FV of investment, and we will also include this in non-current asset in investment. Okay, so amount is 300. We have taken the 30 common. So 5 number. Premier's policy is to value NCI at a fair value at the date of acquisition deemed to be 3.5 million. It means NCI at FV at acquisition is 3500. And number 6, the goodwill impairment is given in the question. Impaired amount is 1500. Okay. And Sanford profit for the year ended 30 September 20x0 was 3.9 million. Okay, 7 sub PAT subsidiary or Sanford PAT equal to 3900. So we will do now working. We have already done one. So working 2. Working 2 is for net asset at net assets of subsidiary at fair value at acquisition, at reporting date, and post acquisition reserve. The difference between the acquisition and the reporting date net asset total is post acquisition reserve. So first we will look for the share capital, which is given in the statement of financial position of Sanford, that is the 5000. So reporting date 5000, और we will assume कि same है at acquisition also. दूसरा है फिर retain earning. So 4500 already given on a date of acquisition. So retain earning at date of acquisition we need to calculate. So in previous video I have also given the formula for the calculation of retain earning at the date of acquisition. So you can go through the previous video and have a just look on it. So we will just take the retained earning at reporting date and minus post acquisition profit, and which is the profit after tax of subsidiary has already given in the additional information, and we will just take 4-month profit. Okay, so here we have for profit after tax of subsidiary, and we will multiply it by 4 divided by 12. So we got 3200. Okay, then we have a fair value adjustment, but the question is telling the fair value adjustment is below its carrying amount, so we will deduct this amount. Bar say 1200. Okay, the same will be on the reporting date as well. So now we will add post acquisition depreciation from reporting date. So 50. Okay. Then we have fair value adjustment done. Okay, yeah. In 2 number we have a PUF which we need to deduct it from the reporting date. The amount is 400. Okay, then we will do total. We don't have anything else to be recorded in the working 2, so we will do total from the start to end. And the difference between these two is post acquisition reserve. Okay, so now we will move to working 3. Working 3, which is for the goodwill. So every consideration paid by parents, here we have, and NCI at FB at acquisition, we have already noted it in the additional information section. So now we will deduct less goodwill impairment, which is already given in the question. Here we go. Then we will deduct net asset of subsidiary at acquisition, which we have calculated, that is 7,000. So now goodwill, we will just add this amount. Okay, so now we will move to working 4, which is for the NCI calculation. So first we will write down NCI at fair value at acquisition, which is 3,500, and NCI percentage of post acquisition reserve, I have write it down in the shortcut PAR, post, which stands for the post acquisition reserve. So NCI percentage is, I think, 20, yeah, 20% into post acquisition reserve we have calculated now in working 2. So, and we will deduct goodwill impairment. We will again take NCI percentage into goodwill impairment. Then NCI equal to sum all these amount. Okay. So we have done with working 4 as well. So now we will move to working 5, which is the last working for this question. So we will take retained earning of parents, which is given in the balance sheet. We can have a look on it. That is 12,300. Okay. Then we will add parent percentage of post acquisition reserve. Okay. So parent percentage is 80% into then we will deduct goodwill impairment. Oh, okay, so parent percentage is 80% into, we have here goodwill impairment. Anything else to be deduct from here? So we have now group retained earning. We will just add all this amount. Okay, so we got group retained earning. So now we will move to in preparation of consolidated financial statement position. Okay, so I will write in shortcut consolidated statement of financial position as at 30 September 20x0. Okay, so first is assets. Okay, and below it is NCA, non-current asset. First we will add a PPE. Just have a look on the formula bar what I am writing. So non-current asset of parent is 500 and subsidiary is 13900. We will deduct the fair value adjustment and add 50 the post acquisition depreciation. Because why? Because it is below the carrying amount. If a question have told us that it is excess of the carrying amount, we will just add the fair value adjustment and deduct the post acquisition depreciation. But here in the question it has been mentioned that it is below from the carrying amount, so we will deduct the fair value adjustment amount and add back the post acquisition depreciation. Okay. Okay, now investment. Okay, investment, just have a look on the formula bar what I am writing. Investment amount is 1800. In the question it has been told that share consideration has not been recorded by the premier, only the cash consideration has been recorded, so we will deduct the cash consideration amount, that is the 800. Okay, and again one point also, one more point has been mentioned in the additional information that the fair value of investment income has been increased by 300, so we will add 300 as well. Okay, and so instead of the investment in the subsidiary we will just replace it by the goodwill which we calculated in the working 3. So we will just put the value one by one. Goodwill, yeah, here. Okay, so total of all these three is sum. Okay, now current assets. In current asset we have inventory. The amount is 5300 plus 500, and we will deduct the pop which we have calculated here. Okay, so we have 5400 as inventory, and receivable we will add both receivable 4200 plus 100. We will deduct the intra-company transaction. Here we have receivable amount 480. So 4820 is receivable balance for the consolidated statement of financial position. Now bank. So bank amount is 3000 plus 800 plus we have again here the cash in transit which has not yet received by the Sanford, but we will assume here the all cash have been received which is due between the parent and subsidiary. Okay, so we will add total assets equal to sum. Okay, so we will bold this amount. Okay, now equity and liabilities. Okay, so we have share capital. We will not add the both parent and subsidiary share capital. We will only take the parent company share capital which is 12,000, as well as the share consideration which has not yet been recorded by the parent. So we have already passed, I think, journal entry which is, I think, below. Wait, yeah, we have share capital. We will add this amount 2400. Again we have a share premium in the share exchange consideration which we have calculated. Here we have share premium which is 9600. Okay, so other equity reserve which is 500 given in the questions, and plus there is indication in the note 4. In note 4 we have a the fair value of investment. You can see over here. Wait, I will go through this. Here we have 300. The fair value investment have been increased by 300. We will add it. Okay, so now Okay, group return earning we have calculated in the working 5. We will just write down W5 for the indication of calculation figure. We have here, yeah, we have. Okay, then we will write down NCI which we calculate in the working 4. So again we will go through it. Okay, yeah, it's done. So total sum. Hmm. Now liabilities, we have current liabilities 15,000 plus 6,800 and minus the payables. Okay, so we don't have a non-current liabilities, so we will add up this amount. So total equity and liabilities equal to this plus this. So both assets, total of assets and equity and liability are equal, so it is correct. Okay, so in this video we will do only one question. In next video we will do the question 415 of the same F7 Kaplan kit. So if you are watching my video for the first time, please like and subscribe to my channel and share it among your friends so they can also have the benefit, and don't forget to hit the bell button. Okay, so bye bye, take care.